Now, how do you run a mixed asset or multi-asset or allocation fund when so much of investors' success recently has not just been concentrated in equities, but US equities and beyond that, the Magnificent Seven? That's a question that such managers are grappling with at the moment, and by all accounts, they've not been doing too well. Here to tell us more is Tom Mills from Manager Research Team. Tom, thanks for joining me. What has been going on in this space?
Hi, Ollie. Good to be here. So you summarised quite well some of what's been going on, a lot of what's been happening in markets over the past couple of years. So 2023, it was characterised by equities performing much more strongly than bonds, and within equities, US equities and the Magnificent Seven drove a lot of that. One way that's kind of come across in performance results of multi-asset funds, and I'll focus on talking about flexible funds, which have wide leeway to alter their asset allocation mix. 2023 was a more challenging year for them, generally because many of them had lowered their equity exposure in 2022 in response to seeing more risk in markets, in risk assets, and also bonds becoming more attractive at the same time with the bond sell-off that we saw. So coming into 2023, a lot of managers in the flexible allocation space had relatively low equity exposure. So it was a bit of a double whammy last year, with having less equity exposure than usual, but also if they didn't have exposure to those areas, those sort of growth and US-centric areas of equity markets, it was challenging. So what we saw in flexible allocation was the category average underperformed the moderate index by which is a 50% equity, 50% bond index, by about 3%, which is, I guess that it was a market where it was mainly driven by equities.
Okay, and you've got two specific examples. So to practical matters, what are the two kind of examples that really show this or don't show it?
Sure. So a couple of funds in the flexible space that we rate highly. The first one is Trojan Fund, which is it's a capital preservation fund that's designed to preserve capital, but also to grow and outpace inflation over the longer term. It's run by Sebastian Lyon at Troy, who's managed the strategy very successfully since 2001. It's got a very impressive long-term track record. It's provided that capital preservation, but it's also kept up well overall with markets, and it's done well against that moderate index that I mentioned. So in 2022, Sebastian Lyon and the team began to be more cautious on equities, and they reduced their equity allocation from around 40% to around 25%. And in 2022, the fund, although it lost a little bit of money, it did better than the market. It did better than the moderate index, which was down about 10%. In 2023, that cautious positioning did hold returns back a little bit. Returns were positive, but they were obviously didn't keep up with such a strong market. So the index was up quite strongly, driven by equities last year. In terms of what the fund does, it invests in a mix of high quality equities, government bonds, including inflation-linked bonds, cash and gold. So that mix can change, but it's been in more defensive mode over the past couple of years. But over the long term, it's done an excellent job of preserving and growing capital.
And to example two then, how does that compare and contrast?
So the second fund that I'll talk about is the Ruffer Diversified Return Fund, and it was launched in 2021 as the daily liquid version of the Ruffer strategy, but that strategy has actually been running since the 1990s with much success over the long term. The objectives are somewhat similar in the sense that it can be used for capital preservation. The fund aims to not lose money over any 12-month period, but over the longer term to provide positive real returns. One difference is that where Troy would use more conventional assets only, Ruffer will also, as well as conventional assets like equities and bonds, they will also use derivative protection. So Ruffer have a track record of really protecting capital and producing positive returns in extremely adverse environments. So that includes periods like the dot-com bust, the GFC, the first quarter of 2020. And in 2022, that derivative protection was the biggest contributor to performance, and it enabled the diversified return fund to produce a 5% positive return, which was really impressive given that markets were down. The index was down about 10%, or nearly 10% for the flexible category. So 2023 was a much more difficult year for the strategy because, like others in the space, Ruffer were defensively positioned. But that derivative protection ended up being the biggest detractor from their performance in 2023. And it didn't help that the equity exposure that they had wasn't really in the areas of the market that performed well last year. So 2023, really challenging year for the strategy, but over the long term, it's done a good job for investors.
Sure. Just because I'm intrigued, and quickly and finally, we had worse than expected data on inflation from the US yesterday. Are the managers in this space going to be making hasty decisions, or are they taking a longer term view on it?
Well, the two that I've spoken of will make decisions are framed in a longer term context. So they will have portfolios that are designed to weather a range of different scenarios. So, for example, the Ruffer strategy is described as an all-weather portfolio that should be able to produce returns in any environment. And similarly, Sebastian Lyon at Troy doesn't make sharp tactical moves. It's more with a longer-term mindset.
Sure. Okay. Thanks very much, Tom.
Thanks.
For more on fund investing, check out any of our editorial websites internationally, but specifically morningstar.co.uk. Until next time, my thanks again to Tom. I've been Ollie Smith for Morningstar.